This is Real Estate Rookie episode 404. My name is Ashley Kerr, and I'm here with Tony J. Robinson.
Welcome to the Real Estate Rookie podcast, where every week, 3 times a week, we bring you the inspiration, motivation, and stories you need to hear to kickstart your investing journey. And today we've got, as always, a lot of great questions for you. We're going to talk about how to classify CapEx versus repairs and maintenance. We're going to talk about cash flow requirements. What's a good deal versus what's not. But up first, we're going to be talking about everyone's favorite phrase, tax write-offs. So our first question up comes from Stephanie Farber. And Stephanie says, are write-offs different for homes in an LLC versus homes in my primary name? This is $1 million question, and probably one that I think is a big misconception amongst new real estate investors. And I would encourage you guys to go back and just search for any episode we've done with Amanda Hahn. She's an amazing real estate CPA, written a bunch of books for her and her husband, Matt McFarland, have written a bunch of books for Bigger Pockets. So they can really give you the inside scoop. But here's the thing. Your LLC is not necessarily for tax purposes. Your LLC is for liability protection. So you can still claim deductions and business expenses through a property, even if it's in your personal name. So the title doesn't necessarily matter for your ability to write things off. The title is more so if someone needs to, or not needs to, but if someone chooses to sue you, or there's some kind of liability event, the LLC is there to protect you. Now, there are some, like if you set up an S Corp, there are some benefits to doing it that way. But when we talk about just owning rental property, whether the title is in Tony Robinson's LLC, or if it's in just Tony Robinson's name, there's no material benefit or downside either way. Ash, have you seen anything different from that?
No. And in New York State, when you file for an LLC, you can elect to have it as a disregarded entity for tax purposes, meaning you are literally taxed the exact same as if you own this property in your personal name. It's going on your personal tax return. You're not even filing an LLC tax return, because that's only if you're in a partnership for an LLC. So your LLC is still going to be on your personal return. So as far as write-offs and what you can do differently, when you file an LLC, you're paying tax or you're paying fees on that LLC, the startup costs. So you'll have a little more write-off because you actually have to pay that money. Do I think that is a benefit? No, but and then this isn't really a tax advantage, I would say, but if you do have an LLC, you can open a credit card in the LLC's name. You could use the reward points on that to get, cash back or pay for travel, things like that too. So that's one of the benefits of having an LLC. But yeah, as far as write-offs, they're pretty comparable as to you're not going to be able to write off more in one or the other.
And again, this goes back on a recent episode we did. We talked about the benefit of making sure that you're separating things from like a banking and bookkeeping perspective. So Stephanie, even if you keep the property in your own personal name, I would still encourage you to set up a separate bank account for that property or for your rental business. That way you're not commingling any of the funds from your, the water bill at your primary residence and, your groceries with all of the expenses related to your rental property. So only thing I caution you on is making sure you're still getting some separation between the banking and the bookkeeping side. So we have a question coming up about qualifying for a house hack loan with a partner. But first, we're going to jump into a question about budgeting for property expenses. So this question comes from Carrie Chagnon. And Carrie says, so I typically run my numbers with a 10% management fee, 10% going towards maintenance, and 10% for CapEx. I know most properties, the tenants will pay utilities, or you can correct the rent to include it if you want to. But what about things like sewer, trash removal, pest control, landscaping, snow removal, etc.? Is this all part of the maintenance reserve per month, or should that be added in separately? This is a great question, Carrie, and I'm glad we're talking about this because I think a lot of rookie investors tend to overlook some of the kind of ongoing expenses related to managing a property. Now, for us, since we do all short term, we have to take care of everything, right? So we don't get to charge anything back to the guests aside from cleaning. But Ash, obviously, with you in your long term rentals, What is your approach? Are you bundling sewer, trash, and all those things in snow removal, or is that just a separate line item for you?
So I think there's two distinct categories you should focus on. Is one, your fixed expenses. These are going to be reoccurring every month, every week, every quarter, every year. So then you have your variable expenses, and these you do not when they're going to happen. You don't know what amount that's going to be. So it's variable. You can't say, I know I'm going to spend $1,000 in repairs and maintenance for the year, because you don't know when the repairs or maintenance are going to come up. So that's where I would begin with analyzing your deal. You're going to take the fixed expenses first. So even if you don't know exactly what the lawn care is going to be, you're going to know that you're going to need to pay for it in, May, June, July, August, September, maybe even October. Okay. So you can get a quote from somewhere and you can get pretty close to defining when and how much you're going to need to make that payment. Okay. So say it ends up being $1,200 for that year. So every year you'll need $1,200 to pay. And that's where you're baking it right into. So if I take $1,200, I divide it by 12, that's $100 each month that I am budgeting. So that's $100 of the rental income gone each month. Okay. And you're going to do the same for trash removal. Pest control was an example in there. I only offer pest control, I think it's like the first 60 days. After that, if it is something like you're getting ants in the property or there's mice in the property, that is usually not related to something wrong with the property. We first will assess the condition of the property as to, is there garbage all over, things like that, that's actually causing pests to actually enter the property. Of course, if it's, the property isn't, has a hole or something that has formed into the back of the house where mice are coming in, things like that. We will cover pest control, but most of the time, any kind of like bugs or things like that, we don't even add that in. We put in the lease agreement that that's the resident's responsibility. But myself personally, I would categorize pest removal as to a repair and a maintenance. Because it's not going to be reoccurring. It's going to be something that can come up irregularly. I think one time we had like a squirrel that got into an attic or something like that. And then landscaping, snow removal, you should be able to estimate what that is. So one property, I do flat rate billing. So I pay them $1,200 for the season. And I know that's what my cost is going to be. Other snow removal companies, we use another one for the apartment complex where we're billed per the time they go. So every time they plow, we're billed. And you can kind of estimate that, that you're going to need to pay for it. Some years you may be under budget for that. Some may be over, but you're still better off putting a number on that amount based off of estimates than you are putting a percentage. Like, okay, I think 10% of the rent will go to snow plowing. You're better off putting a dollar amount to that. So then for management, maintenance, and CapEx. Management, you can actually figure out that can be a fixed cost because you're figuring out exactly what it's going to be based off of what your rental income is going to be. Okay. So sometimes just easier in the calculators, like Bigger Pockets calculator reports, just has you put in the percentage because that's what property managers usually charge is a percentage of your rent. But maintenance and CapEx are the ones that you really, really can't budget for as well because CapEx a little bit easier knowing like down the road, okay, our hot water tank is 10 years old. Our roof is 30 years old. Like you may know, and when you purchase property, you can actually get a detailed report from the home inspector saying, here's what I think needs to be replaced in 1 year. Here's what I think needs to be replaced in 5 years. Here's what I think will need to be replaced in 10 years. And you can budget better for CapEx. But for the variable maintenance and things like that come up, that is where it's really going to be hard to actually put a fixed dollar amount onto what those expenses are going to be. So for your reserves, you are going to be saving as to what you have to pay for if the property becomes vacant or if repairs and maintenance come up. Okay, so that's what you need to worry about. So think about what your fixed expenses are for, over the course of a month. So you're going to take all of those fixed expenses. You're going to take your mortgage payment, your principal, your interest, your insurance, your property taxes, if you're going to be paying the utilities, what is that total? And what if you were vacant for 3 to 6 months? Do you have that amount saved to be able to pay for that to happen? And then plus you want to add in 10% always sitting and saving for maintenance and CapEx. But make sure that when you're saving that amount, you're not going above and beyond. So that doesn't mean for every year for the next 30 years you own this property, you're taking, 20% of that to put into savings. And, by year 30, you have, $200,000 just hitting in an account that's earning 0.01% interest. Okay. So at a certain amount, you get to that threshold where you don't need to, keep adding on reserves. What you do is you set that dollar amount. What's that, 6 months? And then if you need to pull money out, I dip into that month's cash flow before I touch my reserves account. So if I have enough in that month's cash flow to actually pay for that repair, I do that first. And then if I have to tap into my reserves because that month's cash flow won't cover it, then I'm actually going in the next month, I'm going to replenish my reserves back to that amount. And then as you start to add properties to your portfolio, you may get to the point where you're not going to have that X amount of dollars per every single property, because the chances of every single property having the roof fly off the same exact month and having to put new ones on most likely won't happen. But so that's where being strategic and learning how to move money around really adds into play there, as to this is where you can sleep at night, feel comfortable with. Worst case scenario, I have this X amount in reserves, and then always make sure to replenish it, replenish. So that's my tangent on that. I'm wondering about on the short-term rental side of things. How do you guys handle your reserves?
Yeah, I'll comment on that, but just so much good information there, Ash. And just one thing I wanted to circle back on was you're an experienced investor now, so you have a good sense of hey, what are we spending per year on snow removal or pest control, whatever it may be. But for the rookie that's coming in, and same for me, right? Obviously, I have a good handle on what our expenses are, but I'll give you an example of how we're doing this for something new. We just launched our first property with an in-ground pool here in SoCal, and the pool came with a heater, and the heater is a propane heater. So we have to pay for, natural gas to heat the pool. And I don't know how it is in New York, but right now natural gas is super expensive in California. So we didn't really know how to charge our guests to heat the pool. So this is a new variable expense for us that we hadn't really had to navigate before. So a few things that we did to try and gauge what this might cost us. First, we looked at all of the other listings in our market that had pools around our size. And we said, what are those hosts charging to heat the pool currently? That gave us one data set. Then we asked our pool guy, hey, what are you seeing some of your other owners charging that you're working with for heating the pool? And then we asked a propane company, hey, what do you think we should be charging to heat the pool for a guest for a day? So all those 3 different data points gave us an idea of what actually it is that expense might look like on a weekly, monthly basis, and what we need to bill back to the guests to actually heat the pool. So for our rookies that are listening, if this is a new expense, kind of leverage that same approach. Talk to other investors in that market, if you have some, if you know some. Talk to the utilities companies, maybe they can share some insights on what some of those costs might be for a property of your size. And like pest control or snow removal, maybe ask those folks as well, like, hey, what are other properties in this area typically paying on a monthly, quarterly, annual basis for those kind of services? So that's what's worked well for us.
Yeah, actually the gas company that services our area, if you call, you can get, I can't think of exactly what they call it, but like the average balance for the year. They'll do it for like the 6 months, the previous 6 months, or the last year. So if you're purchasing a new property, I always do this where I call, or now I have a VA call, but they'll ask for give the property address and just ask for what the average balance was. So what you could do is you could find a comparable property with a pool, that has the same kind of sized pool, same kind of sized house, where it's all the heat. It looks like it would be comparable to heat those properties to yours, and call and ask what the average balance is. And they can't give you direct billing information, but they could tell you over the 6 months, this was the average monthly billing. I like to always do a full year, ask for the full year, because you have different seasons in the markets that I'm investing in, where obviously the gas bill will be higher in the winter than it will in the summertime too. So calling your fuel supplier to see if they will actually give out that information too on the property.
And then to circle back to your other question, Ash, about how we're budgeting for CapEx, very similar approach, right? So every month we take somewhere between 5 to 10% to cover larger expenses. And Sam, our target is somewhere in that 3 to 6 month range of our principal, interest, taxes, and insurance payment as well. If you have a property that's maybe lower on CapEx, we'll put a little bit more. If you have a property that's higher, then maybe we're not putting anything at this point, right? So very similar approach. We take a percentage of our revenue that comes in every month and we allocate that towards our CapEx and our repairs and maintenance budget. Let's jump into our next question here. This one is from Caleb LaBelle. And Caleb says, on the Real Estate Rookie podcast, they discuss this idea of partnering with an investor to do an FHA house hack. I've thought about this strategy myself as I live in Denver and the prices are pretty high, but I'm still confused on how exactly this would work. Would we both be on the mortgage? If I'm only qualified for a $300,000 home, but my partner's qualified for a $500,000 home, could I still get in somehow? How does this work from a lending perspective? How will this be mutually beneficial? Thanks for any input as I'm trying to wrap my head around this. So Caleb, great question. And I applaud you for asking for clarity on something like this. The whole partnership structure, I think, can be somewhat confusing, but for all of our rookies that are listening, head over to biggerpockets.com/partnerships, and you can pick up the book that Ash and I co-authored on real estate partnerships, where we deep dive a lot of these topics. But let's kind of break these questions down piece by piece, Ash. So the first one here says, would we both be on the mortgage? I'm curious what you think, Ash, but I'll give my insights here first. I think the answer is that it depends. Right? It depends on what is the most advantageous for the both of you together. So I'll give you an example, Caleb, from my own real estate portfolio. Sarah and I have a partner who we worked with to buy our first 3 short-term rentals. And the way that we did the mortgages is that the first one that we bought together, both of our names were on the mortgage because we needed it to get approved for that specific property. The second one that we bought, I think it was actually just his wife's name on the mortgage because we needed her to be able to get that debt. The third one that we bought, I think it was just like my name on the mortgage, right? Because it was just me. So we kind of ping-ponged between our names to see who, I guess, let me phrase it this way, Caleb. You want the least amount of people as possible on the mortgage. That way the other person's name doesn't get tied to that debt. Because when you go out and you're shopping for that next deal, say that me and Ashley buy a property together and the mortgage is $500,000. If I go out and try and buy another property by myself, it's not going to look at that mortgage and say, oh, well, it's Tony and Ashley, so Tony only owes $250,000. I'm going to get that whole $500,000 mortgage applied to my debt to income ratio. Same for Ashley. So even though we're sharing in that debt together, when someone else is looking at it, it's as if we only had that by ourselves. So if you can get the least amount of people on the mortgage possible, in my situation or in my experience, that's usually the best route. What do you think about that, Ash?
I 100% agree. The only stipulation I can see is, you're in a high price area such as Denver, is can you get the house that you want for $500,000? The only benefit of you both going onto the mortgage is that now you most likely could be approved for an $800,000 house, combining what you are both qualified for. And that's where maybe you could buy a duplex or something that you can house hack and actually offset the mortgage. So that's where I would compare the benefit. Like, can you actually get what you want in a home for $500,000? Or maybe you extend your price point where you both can afford, you both go on the mortgage, you get a higher mortgage, but maybe you're getting a property that has another unit in it and you're actually better off than you would have been if you just spent $500,000 on a property. So that's what I would do the comparison, if it makes more sense doing it that way, to be able to be pre-approved for the higher amount together, both going on the loan.
Totally agree with that. And that leans pretty nicely into this next part of his question. But he says, how does this work from a lending perspective? And exactly what Ashley just laid out. The two of you will apply on the loan together, right? So it'll be, Caleb LaBelle plus Caleb's partner on the mortgage application. Both of you will go through underwriting and you'll get pre-approved for an amount together. The two of you as a borrowing party together. And it could be $800,000, the combination. It could be more, right? Depending on what the lender sees when they look at the two of you as a combined unit.
The partner with $500K. So that partner, is going to get the property, put the mortgage in their name, and you won't be on the mortgage, but you can still go onto the deed of the property so that you still have that ownership of the property. And then I would just get an umbrella insurance policy that covers both of your names on the property together. But as far as if you wanted to, I suppose you could still do a joint venture agreement where the property is only deeded in his name and he only has the mortgage in his name. And then you have the property. It's actually, she is the partner, Caleb. What you could do is do a joint venture agreement where the partner with the 500K home goes on the mortgage, goes on the deed of the property. And then you do a joint venture agreement stating that you own 50% of the property and you just have that agreement in place too. So you could do it, different ways like that. And
I would add to that, Ash, even for us when we do JVs, we still go back post-closing to typically add ourselves on the title to reflect that JV agreement. Actually, super sad story, but I feel like it's worth sharing just to show everyone kind of what happens if the title doesn't reflect the partnership. I had a friend of mine who was a husband and wife, and they bought their house together. And then, I don't know, like when rates drops, they end up refinancing. But for whatever reason, when they refinanced, they just did it in the husband's name. And I can't remember why, like they got a better rate or something like that. It made more sense for just the husband, right? They never went back and added the wife on title. They end up getting a divorce. And, they're going through a separation. And I guess they get into an argument. She comes home one day and all her stuff's just sitting at the front door. And she tries to call the cops to say like, hey, I just got kicked out of my own house. And they look at the deed. They're like, hey, sorry, you're not on the deed. And she had to go out and like stayed in a hotel for that night, right? So making sure that the title and the deed match the agreement is important, because if for whatever reason, partnership falls apart, having your name on the title will save you a little bit. Now, obviously, the JV agreement is there to help as well, but that means you got to go to court. You got to litigate to prove and show. So we always try and make sure that the deed matches the JV agreement as well.
That's a great point, and it depends on what state you're in too, as to what especially if you're married, what the laws are there too, as far as who has an interest in what you own.
Last piece of Caleb's question here is, how would this be mutually beneficial? In my perspective, Caleb, you'd have to do the math, right? To see, is it beneficial, right? Like, could you potentially make more cash flow going out and buying a $300,000 home by yourself? Or is there more cash flow getting an $800,000 or $900,000 home and splitting that 50-50 with the partner? And if the cash flow is the same or better doing it by yourself, then yeah, maybe just do it by yourself. If the cash flow is better doing it together and getting a $800,000 or $900,000 home, then do it together. But for me, I think it just comes down to the math and what the returns say. What are your thoughts, Ash?
Yeah, I really like the idea of being able to do it in one person's name, live in that house for 1 or 2 years, and then go and get another house in the other person's name, getting pre-approved, and just house hacking, or even doing live-in flips or whatever over the next couple of years and turning each property into a rental unit as you leave.
All right. So coming up, we're going to get to a question about, is there a minimum cash flow requirement that we should be using on rentals? Where's the line between expenses and CapEx? So on and so forth. But first, we have another question about property repairs and how to classify them. So this question comes from Daniel Dow, and Daniel says, what mid-range repairs do you classify as CapEx versus general maintenance? For example, I would think we all consider a clogged drain as maintenance and a new roof as CapEx. But what about things like replacing a water heater, a garage door, or a toilet? And secondly, do you distinguish between these expenses in your books? Daniel, great question. And yeah, I think there is a bit of a fine line there between CapEx and between repairs and maintenance type things. So here's what my bookkeeper or my CPA told me early on, is that CapEx is going to be things that you're going to like depreciate over time, right? Things that have a serviceable life. And, your toilet maybe it has, I guess it does have a serviceable life. But for me, if I'm replacing the toilet, I'm probably going to put that as it's just repairs and maintenance. Whereas something that's going to have maybe a longer serviceable life, that's a slightly bigger expense. Water heater, I would put that as CapEx. Garage door, bigger expense, I would probably put that as CapEx as well. But for me, it's usually like, hey, what is something I'm going to like put on the balance sheet that I'll be depreciating versus what's something I'm just going to kind of write off as a one-time expense. How do you separate it out, Ash?
Yeah, so it's going to be what adds an improvement to your home. So another way to look at this is if you're paying sales tax or not. So on capital expenditures, you don't have to pay sales tax on. Your contractor will give you a little form to sign saying, I installed a new hot water heater. You're not paying taxes on it because it's a capital improvement. So that's one way to distinguish if you don't pay the sales tax on it. Things that add value to your home are an improvement to your property and not just fixing what is already there. But then also you can use, ask your contractor, am I getting a form to fill out for a capital improvement? You put your, business name or your entity name, the property address, what the work was that was done. And then you sign, you're not paying sales tax on it because it is a capital improvement to your property.
I love that breakdown. I actually just Googled capital improvements and there's just stumbled upon a blog post by Stessa, our favorite free bookkeeping software. But it's super, if you guys just Google capital improvement list, for me, Stessa was the first one that popped up and it says capital improvements versus repairs and maintenance. And I like how they broke it down and ties in almost exactly with what you said, Ash, but it says repairs and maintenance are generally one-time expenses incurred to keep your property habitable and in working condition. And then capital improvements are the addition or change that increases a property's value, increases its useful life, or adapts the property to new uses, right? So I guess that's a good kind of litmus test for you as you're kind of trying to make that decision, Daniel. All right, let's jump into our last question here. This one comes from Elizabeth Jane. And Elizabeth says, do you have a minimum cash flow requirement to meet on a single family home before putting in an offer? If so, what is your requirement? Man, if I had a nickel for every time someone asked this question, I wouldn't be investing in real estate. I'd just be collecting nickels all day. So Elizabeth, I think the first thing to say here is that what the cash flow requirement is varies pretty wildly depending on what your motivations are as a real estate investor. I know some people who are physicians, super high income earning people who enjoy the work that they do, but are taxed at a very, very high rate because they earn a lot of active income. And for them, they use real estate as a tax strategy, right? So for example, I know a lot of doctors or physicians who invest in short-term rentals because of the short-term rental tax loophole, which allows you to use the paper losses from your short-term rental against your W-2 income. So for them, a cash flow of 1% would be fine as long as they're breaking even because they just want to be able to get the tax benefit every year. And they'd rather put that money into an appreciating asset than paying into Uncle Sam. There are other people who hate their jobs immensely and really want to use real estate as a path to leave that W-2 job. So for them, cash flow is going to be more important. There are other people who invest maybe for appreciation long term. And they're like, hey, I don't care if I get cash flow today, but when I'm 75, I just want to make sure that all my properties are paid off and I can live from that. So a lot of it, Elizabeth, comes down to what is your specific motivation for investing in real estate. But let's assume that your motivation is cash flow. Ash, what are your thoughts on what a good litmus test is today for cash flow?
Multiple factors taking into play for your property. So it's so hard to say, if I was to ask this off the top of my head, the first thing would say, if I'm doing a BRRRR strategy where I'm pulling all of my money out and in my market, the price that I'm paying, and it was minimal work for the property, I would say $200 minimum per unit. With me having no cash into the deal, it's going to be just a lazy rental. There's not a lot of oversight, things like that. That's what I'm looking at. But if this is going to be a property that's going to take more of my time and more of my work for cash flow, I want to really know what my cash on cash return is. And so I opt for a 12 to 15% cash on cash return for a long-term rental. So that is after all my expenses are paid. That is after I, saved my reserves. That is for, any vacancies I have, anything that is my goal is to reach that 12 to 15% for property and it not be a ton of work. So if I'm leaving some money into the deal, that's fine as long as I'm hitting that 12 to 15% cash on cash return of what I'm actually investing into the property. So that's a better measure for me than it is. And then I'm also looking at the age of the property too and looking forward as to, okay, even though this is a great cash flow, this is great cash on cash return right now, what do I have coming up in the future? Do I need to put a new roof on where it's literally going to be the cost of all my cash flow for the whole year and completely wipe me out? So kind of budgeting and looking into the future too of possible capital expenditures like we just talked about that will actually change that. So kind of forecasting the next 5 years to see if that cash on cash return is maintainable too.
Actually bring up a really good point of not just looking at the cash flow, but the cash on cash return. Because I could, if I gave you two properties, property A is cash flowing $100 a month and property B is cash flowing $1,000 a month, just looking at those two numbers, everyone would think property B is a better property. But what happens if the person who's cash flowing $100 per month only has $3,000 into the deal? That's a crazy good return. And what if the person getting $1,000 per month put in $500,000? Terrible return, right? So I think looking at not just the raw number of the cash flow, but the actual return on your investment is probably more important. And again, Elizabeth, it's going to vary from city to city, from strategy to strategy, from person to person, depending on what's important to you.
And also market to market. Like if you're in a small rural area that, maybe I sometimes call them a headache property where there's not a great tenant pool and, there's going to be problems with the property because it's just never was built right, never was fixed right. And under every layer, there's going to be, it looks fine. It looks livable. It looks great. But like, there's literally someone who's done the electric 50 different ways in the property. The floors are uneven, just all these different issues that would come up. And you don't have a large tenant pool to select from either, or you just don't have, it's a lower class neighborhood where you're not having, you might have to lower your credit standards. You might have to lower your arrest record standard, different things like that, where you can get a great cash on cash return. We hear about Detroit as to like one of the best cash flowing markets there is, but you have a lot of problems with your properties. You also don't have a lot of appreciation at all. So also take into account the appreciation factor, because I think there's really good balance that you should find as to give up a little bit of cash flow to get more appreciation in a property too. Okay, well, that is our episode today for Rookie Reply. Thank you so much for listening. If you loved this episode, please give us a like on YouTube or subscribe to your favorite podcast platform for our show. Thank you guys so much for listening. I'm Ashley and he's Tony. If you want to be featured on a Rookie Reply episode, make sure you go to biggerpockets.com/reply. We'll see you guys next time.